Hi. Welcome to the new channel Masters of Finance. This video is the second of many in a series on valuation. In this video, I will begin to explain the discounted cash flow valuation method. Discounted cash flow analysis is a key concept in valuation. The idea behind this method is simple. The value of an investment is determined by the magnitude and the timing of the cash flow it is expected to generate. For example, let's assume you invest in a coffee shop. The coffee shop generates cash inflows like coffee and donut sales and cash outflows like supplies, wages, and taxes. Moreover, there is also non-routine cash outflows like equipment maintenance when needed. Discounted cash flow can be obtained by a three-step process. First, the analyst needs to forecast the amount and timing of future cash flows. This task can be really difficult since the future can never be known with certainty, and forecasts must be made with little or no historical data. This video will focus on this step of the process. Future videos will address the last two steps where the discount rate is taken into account. Let's start with defining the cash flows. There are three important issues while defining the cash flows. 1. What cash flows are relevant to the valuation of the investment? 2. Are the cash flow forecast conservative or optimistic? And 3. What is the difference between equity and project cash flows? To the first point, only cash flows that are a direct result of the acceptance of an investment are relevant to the valuation. These cash flows are referred to as incremental. These include direct cash flows generated by the investment as well as indirect effects that the investment has on other lines of business. For example, a new flavor of coffee in a coffee shop may take revenue away from an old flavor. Also, the cash flows referred as sunk costs are not relevant. Sunk costs are expenditures that have already been made or must be made regardless of the investment. To the second point, the cash flows can be optimistic or conservative. Overconfidence and incentives like managerial bonuses cause an optimistic cash flow forecast. The need to lower expectation, for example when the bonus of the analyst depends on reaching the cash flow target, might cause a conservative forecast. Before discussing the third point, we need to define the free cash flow. The free cash flow is the amount of cash flow that is available for distribution to the various claimants after paying all the firm's expenses and investing in new projects. Now to the third point, when discussing project valuation, project free cash flow is used. Firm free cash flow can also be used when we discuss the valuation of a business. As for equity free cash flow, it refers to the amount of cash flow available for distribution to the equity holders. The equity-free cash will be defined in more details in another video. We will now focus on calculating the firm or project-free cash flow. Remember that when the free cash flow is obtained, the first step of our three-step process is over. To calculate the free cash flow you need several information that you can obtain directly or indirectly from the balance sheet. I will assume that you are able to read financial statement and obtain these values. First, the earnings before interest and taxes, the tax rate, the depreciation expenses, the capex, and the change in net operating capital must be known. Then, you can use the formula presented here to obtain the free cash flow. In this example, the free cash flow of Company A is $68,000 for 2018. This will end the first video on discounted cash flow. In part 2, the Company A free cash flow determination will be presented in details.